There is a retirement account available to virtually every working American that lets your money grow completely tax-free. Not tax-deferred, tax-free. You never pay taxes on the gains. You never pay taxes on the dividends. You never pay taxes on the withdrawals in retirement. The IRS cannot touch a single dollar of growth once it goes in. And the people who benefit the most from this account are young investors. People in their 20s and early 30s who have the most time ahead of them to let that tax-free compounding work. It's called a Roth IRA. And if you don't have one, or you have one but don't fully understand how to use it, this video is going to walk you through everything. What it is, how it works, why it's one of the most powerful financial tools available to young investors, what the 2026 rules look like, and exactly how to open one and start building inside it. Welcome to Global Finance Watch, where we break down the strategies, trends, and decisions that drive real financial outcomes. Subscribe if you haven't, new videos every week. Let's start with what a Roth IRA actually is. IRA stands for Individual Retirement Account. It's a type of account with special tax advantages designed to encourage people to save for retirement. There are several kinds of IRAs, but the two most common are the traditional IRA and the Roth IRA. They both let you invest in stocks, bonds, index funds, ETFs, and other securities. The key difference between them is when you pay taxes. With a traditional IRA, you contribute pre-tax dollars. That means you get a tax deduction on your contributions today, your money grows tax-deferred, and then you pay income taxes when you withdraw the money in retirement. You're essentially agreeing to pay taxes later in exchange for a break today. With a Roth IRA, you contribute after-tax dollars. There's no deduction on your contributions. You've already paid tax on that money before it goes in. But from that point forward, every dollar of growth, every dividend, every gain is completely yours. When you withdraw in retirement, you pay nothing, zero. That distinction sounds simple. The numbers behind it are staggering. Here's a concrete example. You're 25 years old and you contribute $7,000 to a Roth IRA, the 2026 annual contribution limit. You invested in a broad S&P 500 index fund and earn the historical average return of roughly 10% annually. You never contribute another dollar. By the time you're 65, that single $7,000 contribution has grown to approximately $307,000. In a Roth IRA, every dollar of that $307,000 is yours tax-free. In a traditional IRA or a 401k, assuming a 22% tax rate in retirement, you'd owe roughly $67,000 in taxes on that balance, leaving you with about $240,000. The Roth advantage on a single $7,000 contribution held for 40 years is worth around $67,000. Now multiply that by every year of contributions across a full career, and the advantage becomes enormous. This is why financial advisors, investment professionals, and essentially every credible voice in personal finance consistently call the Roth IRA one of the best accounts available. Warren Buffett has said he wishes Roth IRAs had existed when he was young. The ability to lock in your current tax rate, which for most young adults in the early stages of their career is lower than it will ever be again, and then let decades of compounding grow completely outside the reach of the IRS, is a structural advantage that doesn't come along often. Now let's go through the 2026 rules so you know exactly where you stand. The contribution limit for 2026 is $7,000 per year. If you're 50 or older, you can make an additional $1,000 catch-up contribution, bringing your limit to $8,000. These limits apply across all your IRAs combined. So if you have both a Roth and a traditional IRA, your total contributions to both cannot exceed $7,000 for the year. You have until the tax filing deadline to make contributions for the prior year. That means you can contribute to your 2025 Roth IRA anytime between January 1st, 2025 and April 15, 2026. This gives you a window if you didn't contribute during the year itself. To contribute to a Roth IRA, you need to have earned income, wages, salary, freelance income, self-employment income. Investment income like dividends or capital gains doesn't count. You also cannot contribute more than you earn in a given year. So if you made $4,000 working a part-time job, your maximum Roth IRA contribution for that year is $4,000. There are also income limits. Roth IRA eligibility phases out at higher income levels. For 2026, single filers can make full contributions with a modified adjusted gross income below $150,000. The ability to contribute phases out between $150,000 and $165,000 and disappears entirely above $165,000. For married couples filing jointly, the phase-out range is $236,000 to $246,000. If you earn above these thresholds, there's still a strategy called the backdoor Roth IRA, which we'll touch on shortly. But for most young adults just building their careers, the standard contribution is fully available. One of the most useful and underappreciated features of the Roth IRA is the contribution withdrawal rule. Because you've already paid taxes on the money you put in, the IRS allows you to withdraw your contributions, not your earnings, but the actual dollars you contributed at any time for any reason, with no taxes and no penalties. This makes the Roth IRA function as a kind of last resort emergency fund if you absolutely need to access the money before retirement. You should not plan to do this. The whole point is to leave it alone and let it compound. But knowing the option exists removes the anxiety that some people feel about locking money away for decades. For earnings, the growth on top of your contributions, the rules are stricter. To withdraw earnings tax and penalty-free, you need to meet two conditions. The account must be at least 5 years old, and you must be at least 59.5 years old. Withdrawals before those conditions are met are generally subject to income taxes and a 10% early withdrawal penalty. There are exceptions: first-time home purchase, certain education expenses, disability, but the core design of the account is for retirement. Now let's talk about what to actually invest in once you have a Roth IRA open. Opening a Roth IRA is just the first step. The account itself doesn't do anything until you invest the money inside it. This is a mistake a surprising number of people make. They open the account and leave the money sitting in cash, earning almost nothing, wondering why it isn't growing. For most young investors, building a long-term portfolio inside a Roth IRA, a simple index fund approach is hard to beat. A broad U.S. market index fund, like a total stock market fund or S&P 500 fund, gives you instant diversification across hundreds or thousands of companies at a very low annual cost. Adding an international index fund gives you exposure to companies outside the U.S. If you want maximum simplicity, a target date fund does all the allocation work for you. It holds a diversified mix of stocks and bonds and automatically adjusts toward more conservative investments as your target retirement year approaches. The logic for holding index funds specifically inside a Roth IRA is particularly strong. The Roth IRA is your highest value tax shelter. Growth that happens inside it is permanently tax-free. So you want the highest growth, highest return assets you own to be inside the Roth, not sitting in a taxable account where gains will be taxed. Stocks, historically the highest returning asset class over long periods, belong in the Roth. More conservative assets like bonds can sit in other accounts. One concept worth understanding here is called asset location, the strategy of deliberately placing different types of investments in the accounts where they receive the most favorable tax treatment. Growth stocks and high-return index funds go in the Roth. Bonds and other income-generating assets that produce regular taxable distributions can go in a traditional IRA or 401k, where the taxation is deferred. This isn't essential when you're starting out, but as your portfolio grows across multiple accounts, thinking about asset location can add meaningfully to your after-tax returns over time. Let's talk about the backdoor Roth IRA, because if your income is above the eligibility thresholds or approaches them, this is important to know. The backdoor Roth is a legal strategy that allows higher income earners to get money into a Roth IRA despite the income limits. It works in 2 steps. First, you make a non-deductible contribution to a traditional IRA. There are no income limits on traditional IRA contributions, only on the deductibility of those contributions. Second, you convert that traditional IRA balance to a Roth IRA. The conversion is a taxable event on any pre-tax money in the account, but since you made a non-deductible contribution, meaning you didn't take a deduction on it, you generally owe no additional taxes on the conversion. The backdoor Roth is more complex if you have existing pre-tax money in traditional IRAs, due to something called the pro rata rule, which can trigger taxes on part of the conversion. But for someone whose only traditional IRA balance is the non-deductible contribution they just made, the conversion is typically clean. If you're approaching the income phase-out range, it's worth understanding this strategy and potentially speaking with a tax professional about how to execute it correctly. There's also the mega backdoor Roth, which allows certain 401k participants to convert after-tax 401k contributions into a Roth, potentially moving significantly more than the standard $7,000 IRA limit into a Roth structure. Not every 401k plan allows it, but if yours does and your income disqualifies you from standard Roth IRA contributions, it's worth exploring. Now let's look at why 2026 specifically is a good time to prioritize the Roth IRA. Beyond the standard arguments that apply in any year, tax rates are a fundamental input into the Roth versus traditional decision. When your current tax rate is lower than your expected future tax rate, the Roth wins. When your current rate is higher, the traditional tends to win. For most young adults in 2026, the current tax environment favors the Roth. The Tax Cuts and Jobs Act, which lowered individual tax rates significantly when it passed in 2017, has provisions that are set to expire after 2025. Meaning 2026 is the first year under the new post-TCJA rate structure, and rates for many brackets are scheduled to rise. Locking in contributions under the current environment before potential future rate increases makes the Roth even more attractive than it already was. Beyond tax policy, the broader argument for young investors in 2026 is the same as it has always been. You have time. The tax-free compounding advantage of a Roth IRA is directly proportional to the number of years the money grows. A 24-year-old opening a Roth IRA today has potentially 40 years of tax-free growth ahead of them. Someone who waits until 40 has 25. The value of that 15-year difference at historical stock market returns is worth hundreds of thousands of dollars in final account value. Every year you delay starting is a year of tax-free compounding you cannot get back. Let's bring everything together. A Roth IRA is an individual retirement account where you contribute after-tax dollars and your money grows completely tax-free. No taxes on gains, dividends, or retirement withdrawals. In 2026, you can contribute up to $7,000 per year if you're under 50. As long as you have earned income and fall within the income limits. You can withdraw your contributions at any time without penalty, making the account more flexible than most people realize. You invest the money inside the account. Index funds are the most common and most effective choice for most investors. The backdoor Roth is available to higher earners who exceed the income limits. And the tax environment in 2026, combined with the power of time in compounding, makes this one of the strongest arguments for opening or maximizing a Roth IRA that young investors have had in years. If you haven't opened one yet, the first step is simply choosing a brokerage. Fidelity, Vanguard, and Schwab are the most commonly recommended for low-cost index fund investing. Opening the account online and making your first contribution. The entire process takes less than an hour. The compounding starts the moment the money is invested. Drop a comment below telling us whether you already have a Roth IRA or if this is the video that convinced you to open one. Subscribe if you haven't, and check out our index fund investing guide and our financial tips for young adults, both linked below. We'll see you in the next one.